That envelope, you know the one?
Right.
That official-looking paper, it arrives in your mailbox, IRS return address.
Yeah.
Maybe without much warning.
Yep.
And your stomach just does that little flip, right? You scan the page, see numbers you weren't expecting, and then those words nobody wants to see. Penalty and interest.
Instant stress.
Yeah. Suddenly you feel like you've just been dropped into some kind of tax maze, with rules and charges that seem, well, impossible to figure out. You're probably thinking, what are these exact? How do they even calculate this stuff?
Yeah.
And maybe most importantly, is there anything I can do about it?
Oh, absolutely. That's a completely understandable reaction. That shock, the confusion, it's really common. The tax system, let's face it, can feel pretty opaque, especially when a notice like that lands unexpectedly.
It really can. Feels like this big problem with no clear solution path. But that's exactly why we're doing this deep dive today. We've gathered a whole stack of resources pulled directly from IRS publications. We've got analysis from tax pros, even a look at the specific forms you might use for relief.
Right. We're going straight to the source material here.
Exactly. Our mission today is to really pull back the curtain on these U.S. tax penalties and interest. We want to break down precisely how they're calculated, how they work, and, crucially, explore the official ways the IRS provides for taxpayers like you to potentially reduce or even completely eliminate these charges.
Think of it this way. We're trying to understand not just, where the guardrails are in the tax system, but also the specific escape hatches or pathways they've actually built in for when you run into trouble.
Okay, let's start unpacking this. First things first.
Sure.
What fundamentally triggers a penalty from the IRS? I mean, what action or maybe inaction lands you on that notice list?
So the core idea, and this is straight from the IRS guidance, is pretty straightforward, actually. Penalties get charged when taxpayers don't meet their obligations under the tax law. It boils down to that.
Okay, obligations like?
Well, the most common reasons, the ones that trigger most of those notices, are things like failing to file your tax return on time. That's a big one.
Right.
Failing to pay the tax you owe by the deadline, and importantly, in the right way. Also, failing to prepare and file an accurate return. That's key. Or failing to provide accurate and timely information returns things like W-2s or 1099s if you're a business, or have those reporting requirements.
So it's really a range of things, not just about paying, but also about being on time, being accurate, even with informational stuff.
Exactly. These are sort of the foundational requirements. Not meeting them is what starts that penalty clock ticking.
And you usually don't find out you have a penalty until that IRS notice shows up, is that right?
Pretty much. If the IRS decides a penalty applies to your account, their standard process is to send you that notice or letter in the mail.
Okay.
And that document, that notice, it's absolutely crucial. It should tell you the specific penalty they're charging, state the reason why they charged it, and then outline the next steps you should take.
So it's not just like getting a bill, it's also the explanation and kind of your starting point for figuring out what went wrong and how to respond.
Precisely. And it's so important to read it carefully. Sometimes the issue might just be a misunderstanding, or maybe you need to provide some missing information. Resolving that underlying issue could potentially get the penalty removed entirely. So, step one is always verify the information in that notice.
Now, those notices, they often mention both penalties and interest. How do those two connect? Are they always sort of a package deal?
They are very, very closely linked. And this is where it can really start to hurt financially. By law, the IRS has to charge interest whenever a tax balance isn't paid by its due date. Okay, so interest accrues on the unpaid tax itself.
Right, that makes sense. Cost of using the money late.
But here's the critical part, and multiple sources emphasize this. The IRS also charges interest on the penalties themselves if those penalties aren't paid in full by the date they tell you to pay them in the notice.
Whoa, wait. So the penalty amount, that becomes a new base that they charge interest on. Like,
Yeah.
You get penalized, and then the penalty itself starts growing interest.
That's exactly right. Interest on top of the penalty. It really compounds the cost of not being compliant, and it can add up significantly over time.
Wow.
So the only way to stop future interest and future penalties from piling up is to pay everything the original tax and any assessed penalties in full. That meter just keeps running every single day until that balance hits zero.
Okay, that definitely highlights why you need to deal with these notices quickly. Don't let that snowball start rolling downhill. Right, let's dive a bit deeper into the specific types of penalties. Our sources mention a few, but the two big ones seem to be failure to file and failure to pay.
Yes, those are absolutely the most common penalties taxpayers run into. Let's take failure to file first. This one applies specifically when a required tax return isn't submitted to the IRS by the due date, and that includes any valid extensions you might have gotten.
Okay. And how's that one calculated? It feels like maybe the one that hits hardest right away.
It can add up very, very quickly. The standard calculation is 5%, 5 of the unpaid taxes for each month, or even part of a month, that the return is late.
5% per month. That's significant. So just rough math. If you owe, say, $1,000 and you file just 2 months late, that's already $100 just in the failure to file penalty.
That's correct. 2 months late, you're already looking at a 10% penalty on the original tax owed. It adds up fast. However, there is a cap.
Okay, good.
The failure to file penalty is capped at 25% of the unpaid taxes. So it stops increasing after 5 months of being late.
Okay, so 25% is the maximum percentage for that specific penalty.
Got it.
Got it. And there was a really critical detail in the sources about the timing here. It's calculated from the original due date, right? Not an extended due date.
Yes. This trips up so many people. An extension gives you more time to file the forms, to get the paperwork done and submitted, but it absolutely does not give you more time to pay the tax you owe.
Oh, okay.
So that 5% per month penalty for not filing on time, it still looks back to that original deadline, usually April 15th for most individuals, regardless of whether you got an extension to file in, say, October.
That's a crucial distinction. Pay by the original deadline, file by the extended deadline if you need it. What about minimum penalties? Is there ever like a baseline charge for filing late?
Yes, there is, specifically for returns that are filed really late. If you owe tax and you file your return more than 60 days after the due date, and this includes extensions for this particular calculation, there's a minimum penalty.
Okay.
This minimum penalty is the smaller of two amounts, either $100 or 100% of the tax owed.
Smaller of $100 or the total tax? Can you give an example?
Sure. Let's say you owe $80 in tax and you file 70 days late. 100% of the tax owed is $80. Since $80 is smaller than $100, the minimum penalty would be $80.
Okay.
Now, if you owed $500 and filed 70 days late, 100% of the tax is $500. Since $100 is smaller than $500, the minimum penalty in that case would be $100. It basically ensures there's at least some penalty if you owe tax and file significantly late.
Got it. So the monthly percentage stacks up, capped at 25%,
Yeah.
but there's this floor, this minimum, if you're over 60 days late and owe something. Which types of returns does this failure to file penalty usually apply to?
The sources confirm it applies to the most common ones. Personal income tax returns, that's Form 1040, also applies to partnership returns and S-corporation returns.
Okay, so it covers most individuals and a lot of small business structures.
Yeah.
Where the other big penalty category was failure to pay. How is that different?
Right. The failure to pay penalty is triggered differently. It applies when the tax amount that you actually showed on your return, the one you filed, isn't paid by the due date.
Okay.
It can also apply if the IRS later determines you owe more tax than you reported, maybe through an audit or correction, and you don't pay that additional amount by the date they specify in their notice asking for payment.
And the calculation for that one, is it also that steep, 5% per month?
Yeah. Thankfully, no, it's a much lower rate. The failure to pay penalty is generally 1/2 of 1%. So 0.5% of the actual tax owed for each month or part of a month that the tax remains unpaid.
Okay, 0.5% versus 5% for failure to file. That's a pretty big difference. It almost seems like the IRS penalizes not getting the information, the filing more heavily per month than just being late with the payment once they actually have the return.
That's one way to look at it, yeah. I mean, getting the return filed allows the IRS to actually process it and know what the liability is supposed to be. But while 0.5% per month might sound small, it still adds up over time, especially because, remember, interest is likely compounding on that unpaid tax and potentially on the penalty itself later on. And the failure to pay penalty, just like failure to file, also has a maximum cap. It's also capped at 25% of your unpaid taxes.
Okay, so both penalties max out at 25% of the tax owed, but the rate at which they get there is way different and 10 times higher for filing late than for paying late. That's a really important distinction. Now, were there other significant penalties mentioned in our sources beyond just, filing and paying your basic income tax?
Yes, definitely. Several others came up that are really crucial depending on your situation. There's the failure to deposit penalty. This one's particularly relevant for businesses.
Right.
It applies when certain taxes that businesses are required to deposit, like the income tax and payroll taxes withheld from employee wages, aren't deposited correctly. That means not the right amount, not within the required time frame, or not using the required method, which is usually electronic these days.
Okay, timely deposit of those withheld taxes taxes is a big deal.
A very big deal. The IRS is strict on that because it's essentially money held in trust for the government and the employees.
Makes sense. What about if you file on time, pay on time, but there are just errors or inaccuracies on the return itself?
Yes. Then you might run into accuracy-related penalties. These get charged if you understate your tax liability because of things like negligence or disregard of the rules and regulations, or if there's what's called a substantial understatement of your income tax.
Okay, what do negligence and disregard mean in this context?
So negligence generally means you didn't make a reasonable attempt to comply with the tax laws, or you didn't exercise ordinary and reasonable care in preparing your return. Disregard implies something a bit more intentional, like being careless, reckless, or deliberately ignoring the established rules or regulations.
And what about that substantial understatement part? Is there a specific threshold for that?
Yes, there is. According to the sources, a substantial understatement of income tax happens if the tax you showed on your return is understated by an amount that is the larger of either 10% of the tax that should have been shown, the correct tax, or $5,000.
Larger of 10% or $5,000?
Yeah.
Example.
Okay, say your correct tax liability for the year was $50,000, but on your return, you only reported and paid $40,000. That's an understatement of $10,000.
Right.
Is $10,000 more than $5,000?
Yes.
Is $10,000 more than 10% of the correct tax, which is $5,000? Yes. Since it meets both conditions, and it's definitely larger than $5,000, that would likely trigger the substantial understatement penalty.
Okay, so there's a clear mathematical test for that one. What about problems with the payment method itself, like a check bouncing?
Yep, there's a penalty for that too. It's called the dishonored check or payment penalty. If you send a check or make an electronic payment that doesn't clear maybe insufficient funds or something, there's a penalty.
How much?
If the payment amount was less than $1,250, the penalty is a flat $25. If the payment was $1,250 or more, the penalty is 2% of that payment amount. So definitely worth double checking your bank balance before hitting submit or mailing that check.
Good advice. What about estimated taxes? For people who don't have taxes withheld from a job, like freelancers or people with investment income.
Yes, absolutely. There's the underpayment of estimated tax penalty. This applies to individuals and also corporations who are required to pay taxes throughout the year in installments, known as estimated tax payments.
Right.
If you don't pay enough tax that way, or you don't pay it on time according to the quarterly deadlines, you can get hit with this penalty. It's very common for self-employed folks, people with significant side hustles or investment income, and businesses.
And how's that one calculated? Is it a flat rate?
No, it's a bit more complex. The penalty calculation is based on the amount of the underpayment for each period, how long it was underpaid, and the IRS interest rate that was in effect for that specific quarter, which, as we'll discuss, can fluctuate.
So it's really crucial for those taxpayers to estimate accurately and pay on time throughout the year to avoid that one. Any other penalty categories we should mention?
Yeah, the sources also briefly touch on information return penalties. These are for failing to file or furnish things like 1099s or W-2s correctly and on time, both to the government and to the recipients. There can also be tax preparer penalties if a paid preparer engages in certain types of misconduct. And significantly, there are international information reporting penalties for failing to correctly or timely report foreign financial accounts or activities. Those can be particularly severe.
Wow. Okay. So it covers a really wide range of potential slip-ups, from simple filing and paying to accuracy and specific reporting requirements. Now, thinking about time, is there a limit on how long the IRS has to come after you for these penalties and the associated interest, like a statute of limitations?
This is a really critical point, and for some situations, the answer is pretty stark, actually. Generally, there is a statute of limitations for the IRS to assess additional tax, often 3 years from when you filed the return. However,
I sense a but.
Yes. The sources highlight some major exceptions when it comes to penalties and interest. First, there is no statute of limitations on the failure to file and report payroll taxes.
None at all for payroll tax?
None at all. And maybe even more importantly, there is no statute of limitations on the assessment of tax penalties and interest when a false or fraudulent tax return is filed.
No time limit whatsoever.
Yeah.
So if they determine a return was false, they could theoretically go back decades.
That's what the rule implies for those specific serious situations. And one source made a really interesting connection here. It pointed out that household employment taxes, that the nanny tax, are reported on Schedule H, which gets filed with your personal Form 1040.
Okay.
If you fail to report and pay those required household employment taxes, the IRS could potentially view that as filing a false return because the total liability shown on your 1040 doesn't reflect the true amount owed, specifically because of those missing employment taxes.
Well,
And if they make that determination that it constitutes a false return, then that rule about no statute of limitations for assessing the tax, penalties, and interest could potentially kick in, meaning the IRS might have unlimited time to assess those charges related to the unpaid nanny tax.
that's a powerful consequence and a serious reminder about accurately reporting and paying all the taxes you owe, even things that might seem minor, like household help. Okay, so we've covered penalties pretty thoroughly. Let's pivot now to the interest side. We know why it's charged, basically, the time value of money owed to the government. But how exactly is it calculated? What makes it add up so much?
Right. So interest is charged on any tax that's unpaid and also, as we said, on unpaid penalties, starting from the original due date of the tax payment until the date the IRS actually receives the payment in full. It's fundamentally a charge for using the government's money beyond the deadline.
And the calculation method.
It's calculated based on the amount you owe for each day it's not paid. But the absolute key piece here, which the sources really stress, is that the interest is compounded daily.
Compounded daily. Okay, let's break that down. What does that mean in practice, compared to maybe simple interest or even monthly compounding like you see on some loans?
Daily compounding means that each day, the interest is calculated on the outstanding balance, which includes the original tax plus any interest that has already accrued up to that point.
So the interest itself starts earning interest almost immediately.
Exactly. The next day's interest isn't just calculated on the initial amount you owed, it's calculated on that slightly larger balance from the day before, which now includes yesterday's interest. This means the amount that's subject to interest grows continuously every single day. Over time, this can result in a significantly higher total interest charge compared to simple interest, where interest is only calculated on the original principal or even compared to monthly compounding.
It really is like that snowball effect you mentioned earlier,
Yeah.
gaining a little bit of mass every single day as it rolls.
That's a perfect analogy, and it really underscores why paying off tax debt quickly is so critical to minimizing the total cost.
Makes sense. How is the actual interest rate determined? Is it fixed or does it change?
It's not fixed. The rates are determined and usually posted quarterly by the IRS. For underpayments by individual taxpayers, the rate is generally set as the federal short-term interest rate, which itself is based on current market conditions plus 3 percentage points.
And do we know the current rate from our sources?
Yes, we do. For the first 2 quarters of 2025, the interest rate for individual underpayments is 7%.
7%. Compounded daily.
Compounded daily, yes.
Okay, 7% compounded daily.
Yep.
Yeah, you can see how that can become a really substantial chunk of the total amount owed if a balance goes unpaid for a significant amount of time.
Absolutely. It reinforces the idea that the single most effective strategy to minimize interest charges is always to pay off any tax liability as quickly as you possibly can. Every single day matters because of that daily compounding.
Do the rates differ for businesses or for different types of tax issues?
Yes, the sources indicate there can be slight variations. The rates might differ between individuals and corporations, and there can sometimes be specific rates for very large corporate underpayments or overpayments. But the fundamental mechanism, quarterly adjustments based on market rates plus a margin, and daily compounding applies broadly across the board.
Okay, we talked about when interest starts, the day after the original due date. Does getting an extension to file your return change when interest starts ticking?
No, and this is another really critical point, just like with the failure to file penalty timing. An extension to file gives you more time to submit the forms.
Right, file later.
But it does not extend the deadline for paying the tax you owe. So interest on any unpaid tax liability starts building up the day after the original tax filing deadline, typically April 16th, even if you have a valid extension to file your return in October. The interest only stops accruing when the balance is paid in full.
Got it. Extension to file, not an extension to pay, and not an extension to stop interest from starting on the original deadline. Very clear. Okay, what about the flip side? What if the IRS owes you money like a refund? Do they pay interest if they're late?
Yes, generally they do. There's a rule that if the IRS doesn't issue a refund that's owed to you within 45 days,
45 days.
within 45 days of either the tax filing deadline or the date they actually received your return, if you filed it after the deadline, then they are usually required to pay you interest on that overpayment amount.
Interesting. And when does their clock start for accruing interest they owe you?
Their interest accrual starts from the latest of several possible dates. The original tax filing deadline, the date the IRS actually received your completed return or claim for refund, the date they were actually able to process it, sometimes returns arrive incomplete, or the date the overpayment was actually made, if it relates to estimated payments, for instance.
Okay. And if you do get interest from the IRS on a refund, is that money taxable?
Yes, it is. Any interest you receive from the government on an overpayment or delayed refund is considered taxable income to you in the year you receive it. And if the interest amount is $10 or more, the IRS will send you a Form 1099 INT, which reports that interest income. You'll need to include that on your tax return for that year.
Good to know.
Yeah.
Okay, so that covers the mechanics of penalties and interest, how they get triggered, how they're calculated, how they can grow. It definitely sounds like it could be overwhelming when you get one of those notices. But you mentioned earlier there are pathways to relief. How can someone actually, navigate this system to try and get these charges reduced or maybe even removed entirely?
Right, and this is where understanding the system really becomes empowering. The IRS does provide specific avenues for penalty relief. Now, it's usually not automatic. You typically have to ask for it and meet certain criteria, but it is definitely possible to get penalties reduced or waived in many situations.
Okay. What are the main types of relief that the sources talk about?
The key categories that come up repeatedly are first-time abate, sometimes called FTA, reasonable cause, and statutory exception. The sources also give us a peek into the order the IRS internally tends to consider these. They generally look first to see if an IRS error caused the penalty. If not, they look for any specific statutory or regulatory exceptions that might apply. After that, they consider administrative waivers, like first-time abate. And finally, they'll evaluate reasonable cause based on the taxpayer's specific facts and circumstances.
Interesting. So if you think the IRS made a mistake that led to the penalty, that's actually the very first thing they're supposed to check.
Yes, according to the procedures outlined. Correcting their own potential errors is the initial step in their penalty relief review process.
And we touched on this earlier, but it seems really important, so let's reiterate. If you do manage to get a penalty removed or reduced, what happens to the interest that was charged on that specific penalty?
This is one of the biggest side benefits of getting penalty relief. If an underlying penalty is reduced or removed, any interest that was specifically calculated and charged on that penalty amount is automatically reduced or removed as well. You generally don't need to make a separate request to get that related interest taken off.
That's huge. Knowing that fixing the penalty can also clear out the interest that grew on the penalty.
Yeah.
That's a significant relief in itself. Okay, let's do a deep dive into that first one you mentioned. First-time Abate, or FTA. This sounds like it's aimed specifically at taxpayers who usually do things right, but maybe slipped up once.
That's exactly the idea. First-time Abate is what's called an administrative waiver. It's not something explicitly written into the Internal Revenue Code itself, but it's a long-standing IRS policy. It was put in place back in 2001, really to help streamline the abatement process for certain common penalties. Its purpose is basically to offer a sort of one-time consideration, a break, for taxpayers who generally have a solid history of complying with their tax obligations.
A one-time break. Which specific penalties can you potentially get FTA relief for?
FTA applies to the three most common penalties we've discussed: failure to file, failure to pay, and also failure to deposit penalties, which mainly impacts businesses. It covers these penalties when they're applied to a range of standard return types, including individual income tax returns, Form 1040, corporate returns, partnership returns, and also some quarterly returns like payroll tax returns.
Are there any types of returns or penalties where FTA specifically does not apply?
Yes, the sources are quite clear on this. FTA generally does not apply to penalties assessed on federal state tax returns, generation skipping transfer or GST tax returns, or federal gift tax returns. It also typically doesn't apply to penalties related to returns that have filing requirements triggered by specific events, event-based filings, something called the daily delinquency penalty, DDP, or certain information reporting penalties that are dependent on another required filing. So its main focus is really on those common income and payroll tax filing and payment issues.
Okay, focused on the regulars. How do you actually qualify for this first-time Abate? What does that good tax compliance history look like from the IRS's perspective?
This is where the criteria get pretty specific. To qualify for FTA relief, you generally need to meet two main tests: looking back at the 3 tax years immediately before the tax year for which you received the penalty.
3 prior years.
Yeah.
Okay. What are the tests?
First, you must have filed the same type of return if you were required to file one for all 3 of those preceding years, so consistent filing. Second, during those same 3 prior years, you must not have received any penalties of the type you're seeking relief for now. Or if you did receive a penalty in those prior 3 years, it must have been removed for an acceptable reason other than first-time Abate.
Ah, okay. So if I got a penalty waived using FTA 3 years ago, I wouldn't be eligible to use FTA again this year for the same type of penalty.
That's generally correct, yes. It's intended as a one-time administrative break for a specific penalty type within that recent compliance window. The core idea is you've demonstrated a good pattern of compliance, maybe you had one slip-up, and the IRS is willing to offer this specific waiver. The example given in the sources illustrates this well. If you're requesting FTA for a 2022 failure to pay penalty, the IRS will look back at 2019, 2020, and 2021. You'd need to have filed returns for those years, if required, have no unresolved penalties of that type from those years, and crucially, not have received FTA relief for a failure to pay penalty in any of those 3 preceding years.
Okay, that 3-year clean slate, or previously excused slate, is key. Are there any extra rules specifically for getting FTA on the failure to deposit penalty for businesses?
Yes, there are a couple of additional points for FTD penalties. Beyond the general 3-year compliance history, FTA for failure to deposit might be available if you haven't already accumulated 4 or more failure to deposit penalty waiver codes in those prior 3 years. And importantly, the penalty can't have been charged because the IRS believes you were deliberately trying to avoid using the required electronic federal tax payment system, or EFTPS.
EFTPS. That's the system most businesses have to use now for deposits, right?
Exactly. So if the penalty arose because you were trying to circumvent that required electronic system, FTA likely wouldn't be an option.
Makes sense. Now, what if you meet the FTA criteria, but you still actually owe the underlying tax related to the penalty? Can you still ask for FTA relief on the penalty itself?
Yes, you absolutely can request FTA even if the tax hasn't been fully paid yet. However, and this is a really important however, the sources strongly emphasize that if you request and receive FTA for, say, a failure to pay penalty, but you still owe the underlying tax, that failure to pay penalty will continue to accrue from the date the FTA relief is granted going forward until the tax is finally paid in full.
Oh, okay. So FTA wipes out the penalty up to that point, but it doesn't stop the clock on future penalties if the tax remains unpaid.
Precisely. FTA relief only applies to the penalty amount that is accumulated up to the date the relief is granted or requested. It doesn't provide ongoing relief if the underlying cause, the unpaid tax, persists.
The sources give an example, right? Like you get FTA for a penalty on a 2021 notice. That removes the penalty shown on that notice,
Sure.
But if you don't actually pay the tax until 6 months later.
Then you might have 6 more months worth of failure to pay penalty that has accrued during that time. The example suggests you could potentially request FTA again specifically for that additional accrual period, provided you still meet all the FTA eligibility criteria at that later date when you finally pay the tax. It can get a bit layered.
Wow, okay. So it's relief tied to a specific point in time or assessment, but the fundamental obligation to pay the tax and stop future penalties on that unpaid amount always remains. What's the main benefit then?
The main benefit is getting relief from one or more of those eligible penalties, file, pay, deposit, on a single tax return for a single tax period. And importantly, getting FTA granted does sort of reset your good compliance clock for that 3-year look-back period, assuming you stay compliant going forward. So if you needed relief again many years down the road, having received FTA previously, but outside the immediate 3-year window, wouldn't necessarily disqualify you, provided you met the criteria again based on the new look-back period.
Okay, so first-time Abate seems like a fairly clear, criteria-driven policy. It's administrative, focuses on taxpayers with a good recent track record. What about the other main category, reasonable cause? This sounds much more subjective, more about the specific reasons why someone couldn't comply.
That's exactly the key difference. Reasonable cause relief is available if you can successfully demonstrate to the IRS that you exercised what they call ordinary business care and prudence and acted in good faith, but you are still unable to meet your tax obligations because of events or circumstances that were genuinely beyond your control.
Ordinary business care and prudence,
Yes.
on your control. How does the IRS actually determine if a reason meets that standard? Is there like a defined list of acceptable excuses?
No, there isn't a strict checklist. The determination for reasonable cause is made entirely on a case-by-case basis. The IRS looks at all the specific facts and circumstances surrounding your situation. What might qualify as reasonable cause really depends heavily on the particular penalty that was assessed and the specific reasons you provide.
Which penalties can reasonable cause potentially apply to? Is it broader than FTA?
Yes, reasonable cause generally has a broader potential application than FTA. It can potentially provide relief for failure to file, failure to pay, those accuracy-related penalties we talked about, information return penalties, and potentially others as well. However, the sources do note that reasonable cause generally does not apply to certain penalties, like the underpayment of estimated tax penalty. That one typically requires meeting specific exceptions rather than proving reasonable cause for the underpayment.
Okay. And if the penalty is on a business return, whose circumstances are they evaluating?
The owners.
The bookkeepers.
For a business penalty, the reasonable cause evaluation focuses on the circumstances and actions of the specific person within the business who have the authority and the responsibility to submit the return, make the required tax deposit, or pay the tax liability. It's about the responsible party's situation.
Let's focus on reasonable cause specifically for the big two: failure to file or failure to pay. What kinds of reasons might be considered valid, assuming you were trying your best but still couldn't comply?
The sources give several examples that often revolve around significant, unforeseen, and unavoidable events. These can include things like fires, natural disasters, hurricanes, floods, etc., or major civil disturbances that directly impacted your ability to file or pay.
Okay, things clearly outside your control.
Right. Another potential reason is an inability to obtain necessary records. Maybe the records were destroyed in a fire or held by a third party who wouldn't release them despite your efforts. Critically, the death, serious illness, or unavoidable absence of the taxpayer or a member of their immediate family is often considered a valid reason, provided it genuinely prevented timely filing or payment. System issues, too, like documented problems with IRS electronic filing systems or payment portals that prevented timely submission, can also qualify.
Those all sound like pretty legitimate hardships or external barriers. What about the other side? What kinds of reasons does the IRS typically not accept as reasonable cause for failing to file or pay on time?
This list is just as important for taxpayers to understand. Factors that are generally not considered sufficient for reasonable cause on their own include things like simply relying on a tax professional, like an accountant or advisor. The IRS generally holds you, the taxpayer, ultimately responsible for ensuring your return is filed correctly and on time, and that payments are made even if you hire help.
So my accountant messed up usually isn't enough.
Generally, no. You're expected to follow up, know it's being filed, get proof of filing, etc. Another reason typically not accepted is just a lack of knowledge of the tax law or filing requirements. You're responsible for knowing your obligations or seeking advice to understand them. Simple mistakes or oversights also usually don't qualify unless you can provide additional facts showing you exercised ordinary care but still made the error due to complexity or something similar.
Okay, and what about the big one? Just not having the money.
Right. Lack of funds by itself is generally not considered reasonable cause for failure to pay tax or deposit withheld taxes on time.
That seems tough.
Yeah.
So simply not being able to afford it isn't a valid excuse for the penalty.
That's typically the IRS position, yes. They expect taxpayers to arrange their financial affairs to be able to meet their tax obligations. If you can't pay in full, they expect you to pay what you can and seek a payment plan. However, there's a nuance here. The sources do note that lack of funds might qualify for reasonable cause if it's considered in conjunction with other facts and circumstances that demonstrate you exercised reasonable care and prudence, but were still unable to pay.
So maybe like a sudden, unforeseen financial catastrophe combined with evidence you tried everything possible to manage the situation.
Exactly. It implies something more than just chronic cash flow problems.
Yeah.
They might be considered as part of a larger reasonable cause explanation, perhaps tied to illness or disaster, but it's unlikely to succeed as the sole reason.
Okay, that nuance is important. Lack of funds alone? Generally no, but maybe part of a bigger picture. How about reasonable cause for those accuracy-related penalties? The criteria there seemed a bit different, maybe focusing more on the taxpayer's effort to get it right.
Yes, that's a good way to put it. For accuracy penalties, like negligence or substantial understatement, the focus shifts more towards your intentions and the steps you took. To qualify for reasonable cause and good faith relief, the IRS will look at factors such as what efforts did you actually make to report the correct tax liability? How complex was the specific tax issue involved? What's your level of education, tax experience, or knowledge of tax law? And what steps did you take to understand your tax obligations, or did you seek help from a qualified tax advisor?
What if you did rely on a tax advisor for the issue that caused the inaccuracy?
That's a key factor they consider. If you relied on an advisor, they'll evaluate whether you provided the advisor with all the necessary and accurate information they needed to give proper advice. They'll also consider whether the advisor themselves was competent and had sufficient expertise in that specific area of tax law. It's really about showing you weren't negligent, you didn't intentionally disregard the rules, and you made a reasonable, good faith attempt to comply.
So, for accuracy, it's demonstrating diligence and a genuine effort to get it right, especially if the issue is complicated. What about reasonable cause for those information return penalties, like for late or wrong 1099s?
For penalties related to filing information returns, the standard is slightly different again. You generally need to demonstrate two things. First, that you acted in a responsible manner both before and after the failure occurred.
What does responsible manner mean there?
It means showing you took steps like requesting filing extensions if they were available, trying to prevent the failure from happening in the first place, maybe through internal controls or procedures, and acting promptly to correct the failure once you discovered it. So demonstrating proactive and reactive responsibility.
Okay, that's the first part. What's the second?
The second part is that in addition to showing you acted responsibly, you must also establish either that there were significant mitigating factors involved or that the failure was due to an event beyond your control, similar to the FTF-FTP standard.
Can you give examples of those mitigating factors?
Sure. The sources mention things like, maybe it was the first time you were required to file that particular type of information return. Or perhaps you have a good history of complying with other information return requirements. Issues caused by actions of the IRS itself, or by an agent you reasonably relied upon, or even by another person involved in the process, like the recipient of the form not providing a correct TIN, could be mitigating factors. Problems accessing necessary business records or even documented economic hardship that prevented you from using the required electronic filing method could also potentially count.
Okay, that paints a really comprehensive picture of what reasonable cause entails.
Yeah.
It's definitely not automatic. It's highly dependent on the specific facts and your ability to document and explain why you couldn't comply despite exercising ordinary care. Now, we also saw a really interesting real-world example of a different type of relief, administrative relief, that wasn't FTA or reasonable cause related to the recent pandemic.
Yes, that COVID-19 related penalty relief from late 2023, early 2024 is a perfect illustration of the IRS using its administrative authority to grant broad relief in a very specific situation. They ended up providing about $1 billion with a B in automatic penalty relief.
Wow.
Yeah, for failure to pay penalties specifically on nearly 5 million tax returns from the 2020 and 2021 tax years.
Why did they do that? What was the specific reason for targeting those years in that penalty?
It was directly tied to operational changes the IRS made during the pandemic. Starting back in February 2022, the IRS temporarily paused sending out certain automated collection reminder notices to taxpayers who had outstanding balances.
Okay, they stopped the reminders.
Right. But even though those reminder notices were suspended, the failure to pay penalties kept accruing automatically by law for taxpayers who had received an initial balance due notice but hadn't paid yet. So the IRS recognized that this created an unusual situation where people weren't getting the normal follow-up nudges about their growing debt. Because of that, they decided to provide this broad, automatic relief from those specific failure to pay penalties that accrued during that suspension period for eligible taxpayers.
And it was automatic, you said. People who qualified didn't need to apply or anything.
Correct. For those who met the criteria, the relief was automatic. Eligibility was generally limited to taxpayers who had filed certain common forms, like 1040s, for the 2020 or 2021 tax years, had an assessed tax amount under $100,000 per return, and had been issued an initial balance due notice or entered the collection process between February 2022 and December 2023.
What if someone had already paid those penalties?
If an eligible taxpayer had already paid the penalty that was being waived, they were issued a refund or received a credit on their account.
That's a pretty significant move by the IRS.
Yeah.
But the sources are clear this was a temporary special measure, right? It's over now.
Yes, absolutely. It was specific administrative relief tied directly to those pandemic-related operational changes. That automatic relief program has ended, Failure to pay penalties resumed accruing as normal starting April 1st, 2024, for any remaining unpaid balances for those taxpayers who had previously been eligible for the relief.
So the meter's running again for them.
It is. And the IRS also mentioned sending out special reminder letters called LT38s to taxpayers who have had long-standing debts, sort of as a heads up before they fully resume normal collection activities later in 2024. It really highlights that while the IRS can provide broad administrative relief like this, it's often tied to very specific, unusual, and temporary circumstances. It's not the norm.
Okay, that makes sense. So we've covered the types of penalties, the interest calculations, and the different potential pathways to relief. FTA, based on your track record, reasonable cause based on your specific circumstances, and these occasional special administrative waivers. Now, let's get practical. How does someone actually request this relief once they get that dreaded notice in the mail?
Right. The first and often the simplest step recommended across the sources is to carefully follow the instructions provided right there on the IRS notice you received.
Okay, start with the notice itself.
Exactly. For many common situations, especially if you think you qualify for first-time Abate, or if you have a relatively straightforward, reasonable cause explanation, you might be able to handle the entire request right over the phone. Just call the toll-free number that's usually printed prominently on the notice.
Calling the IRS. What should you have ready before you dial?
Definitely have the notice itself right in front of you when you call. Be prepared to tell them the specific penalty you're calling about. They often have codes. Have your explanation ready why you think you qualify for FTA, mentioning your good prior history, or what your reasonable cause was. If you're claiming reasonable cause, even if you're just talking on the phone, have any supporting documentation, handy dates of illness from a doctor's note, maybe a police report reference number for a disaster, documentation of a system outage, things like that, so you can accurately reference them during the call.
Okay, be prepared. What if calling doesn't resolve it? Maybe the situation is too complex, or the agent can't grant relief over the phone, or maybe you just prefer to put things in writing.
If a phone call doesn't work, or if it's a more complicated case, or you simply prefer a written record, the next step is usually to send a written statement explaining your case. Or, more formally, you can use a specific IRS form. Form 843, which is the claim for refund and request for abatement.
Form 843. Tell us a bit more about that. What's its main purpose, and what kind of information do you need to provide on it?
Form 843 is the standard IRS form used specifically for requesting a refund or an abatement, which means a reduction or removal of certain types of taxes, penalties, or interest. It's definitely the appropriate form to use when you're formally requesting penalty abatement based on reasonable cause or other specific reasons allowed under the law. You could also use it to request FTA if, for some reason, you weren't able to get it resolved over the phone.
And what does the form ask for?
It requires specific details. Your name, address, social security number, or EIN. You need to specify the exact tax period the penalty relates to, the type of tax, like income tax on Form 1040, and the specific amount of the penalty or interest you want abated. Crucially, it asks you to identify the Internal Revenue Code section under which the penalty was charged. You can usually find this on the notice they sent you. This helps them route your request correctly. And then, most importantly, there's space for a detailed written explanation.
The explanation. That sounds key, especially for reasonable cause.
Absolutely. It's not just filling in boxes. You need to clearly and persuasively explain why you believe the penalties should be removed, referencing the specific reasonable cause criteria, if applicable, and detailing the facts and circumstances. You should also explain how you calculated the amount you're asking to be abated, if necessary. And of course, you need to sign and date the form. Attach copies of any supporting documents to the form as well.
So it's really about making a clear, documented case for relief on that form. What happens after you submit the request, whether you did it by phone or by mailing in Form 843? What's the IRS review process generally like?
Once they receive your request, the IRS will review your account information and the details you provided. Interestingly, if you request relief based on reasonable cause, their internal procedures actually direct them to first check if you qualify for first-time Abate.
Oh, really? Even if you ask for reasonable cause?
Yes. Because FTA is an administrative waiver with clearer criteria, they'll often check that first as a potentially simpler path. If their records show that you meet the FTA requirements based on your 3-year compliance history, they will likely just grant FTA relief and notify you in writing. They essentially give you the easiest relief you qualify for.
That's good to know. So what if you don't qualify for FTA?
If you don't meet the FTA criteria, then they will proceed to evaluate your request based on the reasonable cause arguments you presented. They'll review your explanation, look at any documentation you submitted, and consider all the facts and circumstances. Ultimately, you'll receive a formal written notification from the IRS, a letter informing you whether your request for penalty relief has been granted or denied.
And how long does this review process usually take? Are we talking weeks, months?
The time frame can really vary. One source mentioned potentially 30 to 60 days for a straightforward scenario. But complex, reasonable cause requests, especially those requiring detailed documentation review or happening during peak IRS processing times, could certainly take longer, potentially several months. So some patience is often required while they work through it.
Okay. What happens if your request for penalty relief is denied? You get that letter saying no. Is that the final word, the end of the road?
No, definitely not necessarily the end of the road. The sources confirm that taxpayers have the right to appeal a decision by the IRS examination or collection function that denies their request for penalty relief. There's a formal appeals process where you can present your case to the independent IRS Office of Appeals.
That's a really important right, to be aware of the right to appeal a penalty denial. Okay, we focused heavily on penalty relief, and we established that if you get a penalty removed, the interest on that penalty usually goes away automatically. But what about relief from the interest charged on the tax itself? Can you get interest relief independently, separate from a penalty?
Relief from interest itself is much, much more limited than penalty relief. The general rule, stated clearly in the sources, is that interest cannot be reduced or removed simply because you had a reasonable cause for paying the tax late.
So even if I have a perfect documented reason for reasonable cause, say a major illness that prevented payment, and the IRS agrees to waive the failure to pay penalty, I'll likely still owe the interest that accrued on the underlying tax until I actually paid it.
That is typically the case, yes. Remember, interest is seen by the law as a charge for the use of the money, regardless of the reason for the delay. So the interest on the tax itself usually remains, even if the penalty is abated for reasonable cause.
Okay, so when can interest potentially be reduced or eliminated?
The main exceptions are pretty narrow. As we discussed, interest charged on a penalty is automatically adjusted if the penalty itself is reduced or removed. Beyond that, interest on the underlying tax might only be reduced or eliminated in rare cases where the interest accrued specifically because of an unreasonable error or delay caused by the IRS itself in performing a ministerial or managerial act.
Okay. So if the IRS made a significant mistake or took an unreasonably long time to do something they were supposed to do, and that specific action caused extra interest to build up, you might have a case for interest abatement.
Exactly. But you would need to clearly demonstrate that the IRS error or delay was the direct cause of the interest and that it was unreasonable under the circumstances. And importantly, the sources note that interest relief generally won't be granted if you, the taxpayer, or your representative contributed significantly to causing that error or delay.
How would you request that type of interest abatement based on IRS error?
You would use the same form we discussed earlier, Form 843, Claim for Refund and Request for Abatement. You'd need to clearly explain the IRS error or delay and how it directly led to the interest charge you're disputing.
Got it. Are there any other sort of niche situations where interest might be adjusted?
The only other one mentioned briefly is the concept of requesting a net interest rate of 0. This can also be requested using Form 843. It applies in very specific situations where you, the taxpayer, owe the IRS interest for unpaid taxes during the exact same time period that the IRS owes you interest for an overpayment you made. In certain circumstances where these periods overlap, the law allows for the interest rates to potentially be offset, resulting in a net rate of 0 for that overlapping period. But it's quite technical.
Okay, so realistically, interest relief is primarily focused on situations involving direct IRS errors or delays, or it's the automatic consequence of getting a penalty abated.
Yeah.
Given all this complexity and the potential costs involved with penalties and daily compounding interest, what are the absolute best ways to just avoid getting into the situation in the first place?
Well, the most fundamental advice, echoed in all the sources, is pretty straightforward. Consistent compliance. That means filing complete and accurate tax returns and paying any tax you owe by the prescribed due date. That's rule number 1.
File right, pay on time. What else?
If you have requirements to furnish information returns, like 1099s or W-2s, make sure those are also filed correctly and provided to recipients on time.
What if I know I'm going to need more time to actually prepare my return? Like, I just can't get it done by April 15th.
If you need more time to file the return, absolutely apply for an extension. It's usually automatic for individuals using Form 4868, But say it with me.
An extension to file is not an extension to pay.
Exactly. So even if you get that filing extension, you still need to estimate your tax liability as best you can and pay as much of that estimated amount as possible by the original deadline, April 15th for most, to minimize potential failure to pay penalties and stop interest from accruing on that unpaid amount.
Okay, what if I've done my return or I've estimated and I honestly cannot afford to pay the full amount I owe by the deadline? What's the best course of action then? Ignoring it seems like the worst idea based on everything we've said.
Ignoring it is absolutely the worst thing you can do. If you can't pay the full amount, the advice is clear. Pay as much as you possibly can afford by the due date. Even making a partial payment helps. It reduces the principal amount that penalties and interest will be calculated on.
Pay something, anything you can, then what?
Then, immediately contact the IRS or go online to explore their payment options. The most common is an installment agreement, which allows you to make monthly payments over time, often up to 72 months. Setting up a formal payment plan won't necessarily stop interest from continuing to accrue. The law requires that. But it can often reduce the monthly failure to pay penalty rate, sometimes cutting it in half while the agreement is in effect. Plus, it shows the IRS you're proactively addressing the debt, which can help you avoid more aggressive collection actions down the line, like levies or liens.
So pay what you can by the deadline and immediately get on a payment plan for the rest if needed. And the absolute quickest way to stop that daily compounding interest clock from ticking is just to get the full tax balance paid off.
Absolutely. The very moment your account balance hits zero, the interest meter stops running. Paying promptly is always the most cost-effective strategy in the long run.
This all sounds manageable if you understand the steps, but still potentially stressful and complex, especially if you're already anxious about getting that IRS notice. What if someone feels completely overwhelmed by all this? Where can they turn for help?
That's a great question, and the sources consistently encourage taxpayers not to go it alone if they feel overwhelmed. The IRS itself wants taxpayers to resolve these issues, and they, along with other organizations, provide various resources.
What kind of help is out there?
Well, as we mentioned, you can always start by calling the toll-free number printed directly on the IRS notice you received. That connects you to someone who can hopefully address that specific letter or issue. The IRS website, irs.gov, is also a huge resource. It has sections on penalties, interest, payment options, and you can access online tools like your online account.
What can you do in that online account?
You can often view your balance, see payment history, get transcripts, and even set up payment plans like an installment agreement directly through the website yourself without necessarily having to call.
Okay, online tools are helpful. What about getting a person to help?
You can always authorize a trusted third party, like a qualified tax professional, a CPA, an enrolled agent, or a tax attorney to contact the IRS and represent you on the matter. This usually requires filing a Form 2848 power of attorney. For taxpayers who have limited income and meet certain eligibility guidelines, there are low-income taxpayer clinics, or LITCs. These clinics offer free or low-cost assistance with tax disputes, including penalty issues.
LITCs for low-income help. And wasn't there another service mentioned, sort of an advocate within the IRS?
Yes, the Taxpayer Advocate Service, or TAS. This is really important. TAS is an independent organization within the IRS. Their whole mission is to help protect taxpayer rights and assist taxpayers who are experiencing significant financial hardship because of a tax problem, or those who haven't been able to resolve their issues through the normal IRS channels. If you've tried calling, maybe tried dealing with the regular IRS functions, and you're still stuck or facing serious difficulty, TAS can be an invaluable resource to help navigate the system.
Good to know there's an independent advocate like TS available.
Definitely. And the IRS also has a dedicated page on their website just for penalty relief. irs.gov penalty relief. It summarizes a lot of the options we've discussed.
It really sounds like there are multiple avenues for assistance. You don't have to feel like you're completely alone trying to decipher these notices and rules.
Absolutely not. Taking proactive steps, whether that's making the phone call, using the online tools, getting professional help, or reaching out to TS or an LITC is always, always better than freezing up or just ignoring the problem and letting it get worse.
So let's try to wrap up this deep dive. We've really dug into what can be a pretty intimidating topic, IRS penalties and interest. We've broken down the common culprits like failure to file, that's the 5% per month, capped at 25% starting from the original due date, and failure to pay, the 0.5% per month, also capped at 25%. We looked at others too, like accuracy-related and failure to deposit penalties, and we highlighted those really serious no statute of limitations rules for things like payroll taxes and false returns.
Right. And we also unpacked interest, understanding it's legally required on unpaid balances, how it cruelly compounds daily at that quarterly rate, which is currently 7% for individuals. We clarified that getting an extension to file absolutely does not stop interest from accruing from the original payment deadline. And then, most importantly, we explored those key pathways to relief. We detailed the specific criteria for first-time abate, focusing on that 3-year look-back period of good compliance. We examined the nuances of reasonable cause, how it's case-by-case, requires showing ordinary care despite circumstances beyond your control, and how the standards differ slightly for various penalties. And we even looked at that real-world example of special administrative relief related to COVID-19 notice suspensions. We also made it clear that interest relief itself is quite limited, primarily tied directly to penalty abatement or proving specific IRS errors or delays.
Yeah, I think the absolute key takeaway from all of this, from our deep dive into these sources, is really clear. Receiving an IRS notice about penalties or interest can definitely be stressful, maybe even feel confusing or unfair. But simply understanding how these charges work, how they're calculated, and even more critically, understanding the specific criteria and processes for the relief programs the IRS itself offers. Like knowing that 3-year look back for FTA, or knowing what kinds of situations might qualify for reasonable cause. That knowledge gives you concrete, official pathways to actually address the issue.
Exactly. Ignoring that notice or just hoping it somehow disappears, that's almost always the most expensive mistake you can make. It just allows those penalties to potentially grow and that interest to compound day after day. Being informed, taking an honest look at your situation against the relief criteria we discussed, and then taking timely action, whether that's calling the IRS, gathering your documents, sending in that Form 843, or getting help from a professional or an advocate group, that truly makes a world of difference in managing the situation and hopefully reducing what you ultimately owe.
It really does empower you to take control rather than just feeling overwhelmed.
Yeah.
And it leaves you with this final thought to mull over. Given just how complex the tax system is, with all these intricate rules and deadlines we've talked about, and the fact that the IRS has specifically established these formal relief programs like First-Time Abate with very defined criteria based on historical compliance, does the very existence of these structured escape hatches signal a kind of inherent recognition within the system itself? A recognition that sometimes, even for taxpayers who are genuinely trying to comply, just navigating these obligations successfully can be incredibly challenging.
That's a fascinating question. It definitely makes you think about that inherent tension, doesn't it? The balance between needing to enforce the tax laws consistently, but also acknowledging the human element, the potential for honest mistakes or unavoidable difficulties within such a vast and complex system.
Something to ponder. Well, that brings us to the end of our deep dive for today. We really hope this exploration into the nuts and bolts of IRS penalties, interest, and relief options helps you feel more informed, maybe a little less intimidated, and ultimately more prepared should you ever find one of those official envelopes in your mailbox. Until next time, keep digging.